The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.
Good evening and a very warm welcome. Tonight we have a very special edition of Your Money, Your Call. We are talking self-managed super funds, and my name is Sam Henderson, CEO of Henderson Maxwell, an independently owned financial planning firm that specialises in the setup, administration and funds management for self-managed super funds, and I'll be your host tonight while Chris Gray is away. We have a huge show for you tonight, and joining us here is three of the best experts in the self-managed super fund industry. Sally Patton, editor for DIY Super at the Australian Financial Review. Welcome to the panel, Sally. Joining her is Louise Bitty, Director of Strategy Steps, a firm specialising in technical services for financial advice industry. Welcome, Louise. And last but not least, Alex Cook, Managing Director of Arcadian Private Wealth Management. So, team, thanks very much for joining us tonight. We have a huge night ahead. It's certainly been a very volatile day on the share markets, and we're going to be answering all of your questions on self-managed super funds. So if you have a question in regards to setting up a self-managed super fund, running a self-managed super fund, contributions to pension or pension rollovers, portfolio management questions relating to self-managed super funds, we want to hear from you. So don't be shy. What you need to do is to pick up the phone, dial 1300 30 34 35 right now, or email us at yourmoney@Sky Business right now, and I'd be delighted to have our panel address your queries. The first 5 callers or emailers will receive a free copy of my book, Financial Planning DIY Guide, available at Dymocks and all good bookstores. So you'll also get a copy of my new book coming out, Self-Managed Super Fund DIY Guide, which is due out after Christmas. And as I always say, there's never a silly question when it comes to your own money, so please don't be shy. Pick up the phone and give us a call, ask us a question. I'm going to go over to Sally Patton now. Sally, tell us a little bit about self-managed super funds and how popular they are, and perhaps why.
Well, they have become increasingly popular over the last decade, really, but the last year we've seen a really big increase in the number of people setting up self-managed funds. I think it was about 35,000 more funds in the year 2010, 2011. And I think a lot of that is really because people are getting rather angry with their pooled funds, and they're thinking, "Goodness me, I'm losing all this money in my pooled fund. I'm paying all these fees. Why don't I try and do it myself?" And I think that that some people are really thinking, if I'm going to if I'm going to lose all this money, I might as well lose it myself. I might as well take responsibility for it myself. And I think the interesting thing is that over the last year, we've seen a bit of a trend of people coming away from industry funds, either not-for-profit industry funds, into self-managed super, which is something that we haven't really seen before. Traditionally, people have come from the retail sector to come into self-managed funds, and I think that explains partly why the industry funds are setting up a lot of services to try and enable you to invest more flexibly within the industry sector. They've got a bit of a challenge on their hands, I think.
Sure. Are you seeing that trend in terms of the questions that you're getting on in the Financial Review from readers?
In terms of questions from readers, a lot of them are around, say, setting up a pension and transition to retirement. There are questions like, what are the mechanics of setting up a transition to retirement? What happens if I say I'm 55 and I'm made redundant? I might want to take a year's holiday and then come back to work, or I might want to work part-time or full-time, or just a couple of hours a week, or do some voluntary work. How can I access my super savings in those instances?
Sure.
Some of the other things we get asked about are in-specie transfers. What can I transfer into my fund in specie, and what can't I do? We get quite a few questions actually lately about, and it's quite interesting, about contribution splitting.
Right.
Now here I imagine that it's partly because of the change in the rules that's going to occur next year, when savers over the age of 50 will only be able to pump up to $50,000 a year into their super fund if they have balances of less than $500,000. Now, we're not sure why people are asking these questions because they don't tell us why they're asking, but I suspect that there are probably people out there where you've got, say, a spouse, or sorry, a couple. You've got one spouse who's got more than $500,000 in their fund, you've got one spouse with less than $500,000. And they want to use this contribution splitting strategy whereby the spouse with the lower balance is able to maintain that lower balance and contribute more for as long as they possibly can.
Sure. That should be an interesting trend to see what happens when the legislation comes out.
Yeah.
Alex Cook from Arcadian Private Wealth, tell us a little bit about what you're experiencing in terms of what your clients, the new clients, are moving from. Are they moving out of industry funds, they're moving out of retail funds, and why are they setting up self-managed super funds?
Certainly. Yeah, look, in our case, I'd say our business is 80% self-managed super funds. Part of that is driven by the size of the account balance, and that's often a trend. Once you get to above $500,000 in superannuation, it makes a lot more sense to start considering having a self-managed super fund. So that's one of the drivers. And once again, sort of similar to what Sally was saying, the GFC particularly made people sort of question the integrity of the financial sector, and so people are sort of questioning how reliable financial institutions are.
I'm absolutely
and the charges.
fascinated by this because I'm seeing the same trend in my own business, and it's one of those things where people are saying to me, if I'm going to stuff it up, I want to stuff it up myself and take control to stuff it up rather than having someone else do it for me. Is that what you're saying as well?
Very common
yes,
sentiment, yeah, absolutely.
Great. Yeah. Louise, tell me a little bit about what you're seeing. You're the advisor's advisor, so Louise gives the strategy advice to financial advisors and accountants on self-managed super funds. Tell me some of the trends you're seeing at the moment.
Yeah, we're also seeing a renewed interest in setting up self-managed funds, but I think a lot of it's driven by barbecue chatter, that what people are seeing, they're talking about it. There's certainly a lot in the media about self-managed funds, and people think, you're right, that they can do it themselves, but quite often they don't realise the risks that they're actually taking on in doing this as well. There's an awful lot of legislative requirements that they need to meet. It's not as simple as opening a bank account and choosing how you'll invest that. And I think when we look at with the markets, you're right that people are saying they want to take the decisions themselves and make the losses. But what they forget is that if they don't set it up properly with all the steps that the law requires, not only could they have market losses, but they can also lose up to half of their fund as a tax bill.
Absolutely.
So the taxman can take half your money.
Yeah, absolutely.
That's not a good situation.
Yeah. I was just doing a bit of research the other day actually, and I saw one of the top fines you can get is about $220,000 for stepping outside the boundaries, the legal boundaries of managing your fund. Not to mention the fact that you can actually go to jail. So I couldn't imagine sitting in a jail cell talking about why you're in jail, and with your cellmate. It'd be absolutely phenomenal. Thanks very much for your comments there, guys. I'm going to go to Peter now. Peter, what's your question?
Thank you. Thanks very much for taking my call. Currently, I have a do-it-yourself super fund and being provided service by a financial service provider. So I get a wrap, I get to look at my strategy, and we do reviews quarterly to half yearly. What I never actually feel confident about is how much I'm actually being charged, and I would like. My question is, what would be a fair price for that kind of service?
Peter, I'll start off by answering that question if I may. It depends on which wrap service you're with, how much your advisor charges, but generally your fees are broken into three separate areas. You have an advisor fee, you have a platform fee for your actual wrap fund, and then you have a managed fund fee. Do you have managed funds inside that account, Peter?
Holdings as well as managed funds, yep.
Yes, right. So on average, people pay somewhere between sort of 1.8 and about 2.5% for a fund like that. Again, it depends on how much you've got in there. But I might throw over to Alex Cook because a lot of his clients are moving from those wrap funds into direct assets. Alex, what's your opinion here?
In terms of the total cost?
Yeah, total cost to the client.
Yeah, look, Sam, as Sam indicated, there are the three main sets of fees. There's advice fees, so if you're paying an advisor, and the general methods there are either a percentage basis or a flat fee. They're the two most common these days. The commission trends, the commission basis seems to be slowly fading away, and certainly will be banned from middle of next year. In terms of managed funds, it depends, of course, on the asset class to manage funds in. So, for example, if you're in a fixed interest fund, the fees are probably 0.3%. If it's an international fund, the fees can be from 1.5% to 2%. And then, of course, there's the platform fee, and really these fees have halved over the last 5 years, and I think they'll continue to get cheaper over the next 5 years due to competition. And those fees really start at probably as high as 1% and drop down to 0.2%, depending on your account balance.
Great answer. Peter, thanks very much for the call. It's a great question, and certainly a very common one, and probably one of the most common reasons why people have been moving from retail funds into self-managed super funds. But even people moving away from advisors, we've seen a bit of a trend of that in the last few years. People just taking control of their super, of course. Peter, thanks very much for joining us. We have another call now from Abe in Sydney. Abe, go ahead.
Oh, thank you for taking my call. I've got an SMSF fund, and I've got some shares, a large portfolio and cash. And I'm just wondering, in this environment, I don't have an advisor, I just talk to stockbrokers. And am I doing the wrong thing? Maybe I should have some kind of advice in this situation. And what do you do to protect what you've got?
Sure, so great question. Thanks for that. I might go to Louise on for an answer on this one.
Yeah, it is an interesting one in this market. How do you protect your shares? I think good research. We have to note that in these periods, all shares are going to be quite volatile. So whether they're really good quality shares or not, they're all subject to the volatility. So I think it's having in place a good strategy and a plan, knowing how long you've got that you can hold it for, being able to hold on to your shares to ride out the volatility, wait for it to improve. But some good research, some good advice to make sure that you're picking shares that are going to have a business behind them, have a good dividend stream coming through, and be able to recover in the longer term as well.
Louise, tell me a bit about the strategy versus the investment management. That's something I debate with my clients on a regular basis. Tell us about the value of the strategy versus just the investment return.
It's really important with the strategy, and it will depend as well whether you are in the accumulation phase where you're still saving to build up that retirement, or whether you're actually in retirement and starting to draw down on your pension as well. If you're in retirement, not only do you need to think about how long you've got that you're going to be invested for, and the fact of the period of time that you can sit on your investments, but you're also starting to take money out. So for pension phase, the really important part is deciding as well, each year you have to take money out, how you're going to draw that down. And what a lot of people do is have a pool of cash that they will draw out of the cash and then leave the shares invested so that they're not cashing out on those when they are at a low point. So that's really important. For the accumulation side, it's just knowing when's a good time to sell and when's a good time to hold it. So having that place and plan and not being swayed by the emotions in the market and trying to time the market and getting out when you think it's all crashing around you. If you've picked shares that you believe are a good long-term proposition, have good values behind them and potential to recover, and you're planning for a 10, 15, 20-year time frame before you need to use that money, then being able to just sit through and hold on to those shares is the important part of the strategy.
Yeah, great answer. The way I view this is twofold. That there's two aspects to the way an advisor or a stockbroker can help you out. One is the value of the advice and how they can, I suppose, reduce your tax, boost your super and do things like that. There might be TTR strategies or transition to retirement strategies where you pay less tax and boost your super. There might be pension strategies, as Louise said, and other sort of strategic options. The other side to your investment strategy really is around where you're actually going to put your money at the end of the day to get the best return. So I'd suggest that you'd probably have to have a good think about whether there's some value in some strategies to reduce capital gains tax, reduce income tax, and maximise your investments. And on the other side, to maximise your income from the investments and the very integrity of your investment portfolio. But thanks very much. It's a great question and certainly a very popular one at the moment. That's all we have time for in this particular segment. We're going to go to a break now and we'll be back in just a few moments. Welcome back to this very special edition of Your Money, Your Call. My name's Sam Henderson from Henderson Maxwell, and tonight we're answering all of your questions on self-managed super funds. I'm giving away 5 books tonight to the first 5 callers, so don't be shy. And as I always say, there's never a silly question when it comes to your own money. So pick up the phone. That number again is 1300 30 34 35. So please give us a buzz, ask those questions. There's never a silly one. We're going to go straight to an email now. Eddie writes, recently I sold all my script held by my self-managed super fund and I'm now just sitting in cash. I noticed some institutions are offering honeymoon on-call rates, but I'm more interested in their basic on-call rate. HSBC are offering 5.25% yesterday, but is that the best on-call rate on offer? Alex, what are your thoughts on Eddie's email?
Look, in terms of cash rates at the moment, it's very difficult to answer in the sense nobody knows where interest rates are actually going to head. That's the first thing. In terms of, there's a good website where you can go and actually compares all the different interest rates, and that's a website called infochoice.com.au, and there you can actually go and get, it'll list all the institutions, all the major ones, and certainly credit unions as well, and it'll list out the various interest rates for you. And then you can look at call rates versus fixed rates, so you might want to fix the money for 3 months, 6 months, a year, depending on your outlook. And once again, that's the hard part, knowing where interest rates are actually going to head.
Absolutely. I think Eddie was after a pretty specific answer on this one. I don't think we know exactly what the daily at-call rates are. I know I saw one for Eubank yesterday at 6%, but listen, they're changing rapidly at the moment, particularly since the fixed interest market has actually priced in a decrease in interest rates of around about half to 0.6, 0.7 of 1%. So interest rates have certainly come down a fair bit. I might also go to Sally on the answer to this question. Sally, we've seen a lot of changes in asset allocation for self-managed super funds in the past 3 years. Maybe you can tell us a little bit about that movement from riskier assets to the cash style assets.
Well, there has been a really big move actually over the past 2 years. I was looking at some research the other day by a company called Investment Trends, and they found that the amount of money that is being held in cash by self-managed funds has risen from about 75 billion to about 115 billion over 2 years. And what's interesting is if you drill down a little bit in that, the amount of cash which self-managed fund trustees have got sitting in cash waiting to be invested in another asset class has held steady at about $39 billion. But the amount of cash that they think they want to hold, not to invest in something else, but just to hold in cash as an asset class, has risen to about $75 billion in 2 years. Wow. Now that's quite significant, and I guess a lot of that is because a lot of trustees are in retirement phase or approaching retirement phase, so they're trying to de-risk their portfolios. But what that means for equity markets is that's potentially $75 billion that may never go back into equity markets.
Mm-hmm. That's certainly the theory. I actually saw an email today that said what happens when it does rush back into the markets. But what we often find is that people get back into the markets when it starts to move maybe 20, maybe 30%. So often they're actually buying back in at a high level, and that's obviously one of the risks that we have. But thanks very much for the email. Robert from Wagga Wagga, you are live. What is your question tonight?
My wife and I have a do-it-yourself self-managed super fund, and I only mess around with term deposits. Now, when the government guarantee of the term deposits come in February, he's only guaranteeing $250,000. Is our term deposit guaranteed as one identity, or can my wife as a trustee and myself as a trustee hold $250,000 each in it?
Well, my personal opinion would probably be $250,000 each, but would any of my guests like to answer that question?
I'll go. My understanding of it is it's per customer, and the money is held by the superannuation fund, so it's per superannuation fund. But having said that, what you can do is spread the money across a number of institutions. So it's per customer, per guaranteed institution, so per bank. So if you've got more than that, spread it around across a few.
Right, very good. Alex, is that you share that opinion?
That's my understanding, yeah. I mean, the super fund is a single entity, a tax-paying entity, and as a result, that'll be the $250,000 would be seen as one deposit with that particular bank, but there's nothing stopping you from setting up multiple bank accounts across financial institutions in Australia.
Yeah, excellent. Thanks, guys. We have another caller now. Thanks very much for that call, Robert. Great question, and certainly a very common question around cash. There seems to be a lot of questions around cash tonight, not a lot around shares. We have another caller, Ed from Newcastle. Ed, go ahead, thanks.
Oh, thank you. I'm a self-managed super fund person in pension phase, and I've recently heard that when I die, hope not too soon, the fund, what's left in the fund, reverts into accumulation phase and has to pay capital gains tax on all the shares that it might earn, right from the time those shares were bought, if they are going to be inherited by certain people. I'm wondering if there's anything other than selling the shares regularly that stops that occurring. Thank you.
Yeah, great question, Ed. This has certainly been a hot topic among self-managed super fund aficionados in the last couple of days and even weeks. I'm going to go to Louise on an answer for this one.
Yeah, you're absolutely right. This is something the tax department's come out and very specifically said that at the point, the issue is that while you're in pension phase, as you realise, there is no tax on any of the earnings in the fund. So you can sell assets, you can get income, and there's absolutely no tax in the fund. But once you die, they deem it to be back in accumulation, and so we're back into a 15% tax regime for any earnings, including capital gains. So the one strategy is that on a regular basis you could look at deciding whether you should sell assets, and so you reset the cost base and realise those capital gains while you're still in the tax-free environment. If your spouse is still alive, then one of the things you could look at doing is whether you change the pension so that your spouse is listed as an automatic reversionary on the pension. What that does is on your death, the pension then just continues automatically to that person, so it stays in the pension phase and there's no capital gains at that point. But if it's ever then going to be paid out to adult children or people who aren't dependent, they can't take pensions, they have to get the lump sum, the assets would have to be sold. So it is probably the only way around it is going to be, unless we get some changes from the tax department, which we're hoping that maybe we could, but unless we get those, then you would have to look at trying to sell them on a regular basis, unfortunately.
Alex Cook, if I was dying slowly, I could cash my super out over the age of 60 and not pay any tax on it. What is that a strategy if someone is critically ill to cash their super out tax-free, hand it to my adult children?
It's legal under the rules, absolutely.
So do we call this a death tax, or what is it exactly? Because I'm a little confused on this legislation. It's certainly a bit frustrating from an advisor's perspective, and I get asked about this on a daily basis. Sally, you've been writing any articles in this regard, in regards to estate planning and the passing of assets from self-managed super funds?
Actually, it's funny you mentioned that, because you asked before what are some of the big questions, the major questions that we get asked in the paper, and estate planning is probably the third big question that we get asked. And around here, yes, it's these capital gains tax issues. It's also people writing in and asking, for example, if when it goes into the accumulation phase, if you've held assets if those assets have been held for less than 12 months, what is the CGT rate that you'll pay on those assets? There has been, obviously there are people who are really concerned about estate planning. I guess that is reflective again of the average age of self-managed fund trustees and of the fact that the baby boomers are thinking about these issues now.
Yeah, it's certainly one of the major benefits of setting up a self-managed super fund is having that control over the estate planning benefits. So certainly a great question there. I'm going to go on to another caller now. We have Philip from the Gold Coast. Go ahead, Philip. What's your question tonight?
I own a unit within my super fund, and I'd like to know how I could, if it's possible to live in that unit when I sell my place of residence after I retire after 60 years of age.
Sure, great question. Louise Bitty, Strategy Steps, what can you tell me about this answer?
Yeah, my answer would be no if you want it to stay in your self-managed super fund. The assets that are in your fund you can't use or lease to yourself or rent to yourself or live in without them being called what they call an in-house asset. If that happens, you need to make sure that the value of that asset is less than 5% of the total value of your fund. So if you've got an awful lot of money in your super fund and that property is less than 5% of the value, then yes, you might be able to do it as long as it's at commercial rates. But for most of us, no. The only way you'd be able to live in that unit is at retirement to then take that unit out, and you can take the unit out as a whole asset as a withdrawal from your super fund, so that you're then holding it outside super and living in it. And actually that may not be such a bad strategy these days as well, given the discussion we just had on the effective death taxes on CGT, because if you take it out and are living in it, then it's a capital gains free asset as your own home. And you don't end up with all those other issues on death inside your super fund.
So tell us how Philip would cash the money out. How does he take the property out of his super fund?
He just, once he's retired and able to access the money, then you could ask for a withdrawal to be paid. Normally we think the withdrawal is going to come as cash. All it is he asks for a withdrawal to the value of that property, and he just transfers that out as payment for that withdrawal. So it is about the self-managed super fund trustee selling it basically to him, or transferring the ownership to him.
Lovely.
So it's a title transfer.
Alex Cook, are you getting a lot of questions around property and self-managed super funds at the moment?
Certainly there is quite a bit of interest. I don't think it's just the stock market, but certainly the rules are constantly changing, and a few years ago gearing into real estate became a possibility through a self-managed super fund. So yeah, we certainly are getting a lot more questions in relation to that.
Sally, I noticed there's been quite a few articles in the Fin Review about property and self-managed super funds. Where do you see the trends heading for property inside super?
There's been a lot. In fact, a lot of technical experts that we talk to say that the number of inquiries they've had about property and borrowing in self-managed funds has risen astronomically in the last, say, 6 to 12 months. Encouragingly, I think trustees are looking at this very, very carefully, and the trends would show that, in fact, not that many people are actually taking action on the advice they've been given and actually going and buying those properties. The latest figures I saw from the Australian Tax Office showed that only about 3% of self-managed portfolios are in residential property. In commercial property, it's a bit higher. I think the figure there is closer to 10%. But certainly people, I think, are taking notice of some of the restrictions around buying property in self-managed funds using borrowing, and the fact that the banks will offer higher rates. The LVRs, the loan-to-value ratios are lower. So there are some, of course, some issues around repairs and improvements. So I think that people are really sort of taking their stride and thinking quite carefully about whether it is the right strategy for them.
Yeah, great. I actually heard a strategy where you can borrow money inside your super fund, pay it down with tax effective money, and then at retirement cash it out and then go and live in it. So or transfer it outside the self-managed super fund and then live in it as your retirement home. So some really interesting strategies around property inside self-managed super. We're going to go to a break now, so please join us in a few moments. Do give us a call, 1300 30 34 35. Welcome back to this very special edition of Your Money, Your Call. We're talking self-managed super funds. I'm Sam Henderson and I'm joined by Sally Patton, Louise Bitty and Alex Cook, answering your questions all on self-managed super funds. So give our experts a call and test their knowledge. I have the books to give away now, so if you want a free copy of my book, Financial Planning DIY Guide, you need to pick up the phone and dial 1300 30 34 35. We have a question here from Brent in Adelaide. Brent, go ahead.
Oh, thank you for taking my call. I'm ringing about the recontribution strategy. We were talking there before about estate planning, and I've heard that if you can recontribute strategy up to 150,000. Then when you're 65, you get up to the year of 65, you can take 450,000 and recontribution, which helps on your death as far as your adult children with the superannuation. So I'd like that explained to me more if you could.
Yeah, great question, Brent. I'll go to Alex Cook on this one. Alex, can you answer this question for us?
Yeah, sure. Hi, Brent. Look, certainly if you're in the with your superannuation, you can take out pensions from your super fund, and if you are still eligible, you're under 65, and you can contribute that money back into super. You can contribute back up to your non-concessional limits, and the idea of that is to boost the tax-free component, which has obvious tax benefit for your beneficiaries. When when that final day arrives, your beneficiaries are able to get that money out tax-free from your superannuation fund.
Great, thanks for that, Alex. Louise, I might go to you to answer this question a little bit further. We've seen some changes and some PR statements from the ATO in regards to the recontribution strategy in recent years. How many times can we do it, and what are the limits at the moment?
The main limits to note are that you have to be eligible to get your money out, so that means you need to be over at least age 55 and have met a condition of release, so be retired or a number of other things, be permanently disabled. So you must be able to get the money out. You need to be able to put the money back in, so you need to be either under age 65 or over age 65 and still working for at least 40 hours in a 30-day period. The third thing is that when you put the money back into the fund, make sure you don't put in, as the caller was saying, more than the caps that we're allowed to put. So that's normally $150,000 each year, but if you're under age 65, you may be able to put in up to $450,000 in a year. So you've got all those limits to be a little bit careful about. The tax department's always concerned about any strategy which they look at you doing specifically to manipulate tax. And this is one that's always in a grey area about, is it just for a tax purpose or does it have other benefits as well? And we've never got a very clear answer really on that. So at this point, the tax department said, as long as it's a straight, take the money out, put the money back in, they're not too concerned about it. It's where you start to do some other really exotic things around it that they start to get a little bit more nervous. So I think you can do it a number of times. You just need to be careful about your age and how much you're putting in each year.
Great, thanks very much for that. Brent, thanks very much for the call, much appreciated. We're going to go to an email now. We have James from Newcastle writes, I've been with a bank-based allocated wholesale pension balanced fund for 4 years with an ever-reducing capital base and fees of 2.5%. Since July 11, the capital has dropped 6.6% after pension. I have a similar amount and pension in an industrial conservative fund with fees of 1% and a drop in capital of 1.5%. I'm considering swapping the bank fund to the industrial fund. I am aware I'll crystallise my losses, but doubt if I'll see much of the money again in the foreseeable future. In this market, this conservative industrial fund growth has lower fees. Could that work? Could work to my advantage? I'm 65. Alex Cook, we're getting a few questions around this at the moment. What are your thoughts?
Yeah, look, I think there's two key issues that you've raised in your email. The first issue is fees. So clearly, when you're trying to maximise your superannuation benefit, you want it to last as long as possible, and therefore you want to pay as low fees as possible. So that's the first consideration. The second consideration that you're raising, which is really the concern about market risk, and that's what I call the sleep at night test, if you like. How will you sleep at night knowing where your money's invested? So by all means, if you are concerned about that, then you can take less risk. So reduce yourself from a balanced portfolio down to a conservative portfolio is quite a legitimate strategy, so that you can sleep better at night and your money will last longer in the event that global events continue to deteriorate, which is certainly a risk. And as I say, fees is the other one. So certainly looking for low cost providers, and there are plenty of them out there, is a legitimate strategy as well.
Great. Sally, Alex and I are both advisors, so we probably should stay out of this conversation. But what sort of trends are you seeing inside the paper, and what articles have you been writing in regards to advisors and the value of advice at the moment?
Well, actually, I saw some figures the other day showing that only about 50% of self-managed super fund trustees sought advice from a financial advisor in the past 12 months. About 86% use an advisor of some sort, but that includes stockbrokers and lawyers and accountants. So yes, I'd say that it's tricky out there in advisor land. But I was thinking about that question that was just asked. I think the important thing for me is that. I think before the global financial crisis, when you got to retirement age at, say, 60, 65, there was quite a good argument to say, because we might live until we're 85 or 90, that in fact a growth strategy was not a bad one. You could afford to have a fairly aggressive strategy. But I think the markets over the last couple of years, and particularly this week, have shown us that really when you get to that age, it's probably not such a great idea. And that in fact, just as you're retiring at, say, 60 or 65, you're probably at your most vulnerable, because you really can't afford a loss of, say, 10 or 20 or 30% in your portfolios. Maybe when you're in your late 70s, your 80s, you could probably take a bit more risk, but that's probably a time at which you really don't want to be taking on too much risk right now.
Absolutely, great answer. Thanks very much for the email there, James. We're going to Sam on the Gold Coast. Sam, what's your question tonight? No, we don't have Sam from the Gold Coast? No Sam from the Gold Coast, okay. Thought we might have had Sam there, but we're going to take a short break now, so we're going to take a break. Give us a call, 1300 30 34 35 for your questions on self-managed super. Welcome back to Your Money, Your Call on this very special self-managed super fund edition. My name's Sam Henderson, and tonight we're answering all your questions on self-managed super funds. There are only a few minutes left, so get in and call us quickly on 1300 30 34 35. As I always say, there's never a silly question when it comes to your own money. And certainly in the last 3 years, not enough people have been asking those silly questions about their own money. We have had quite a few calls about getting a copy of my book, which I've got right here today. You do need to ask a question. It's not free, but you can get it off my website at hendersonmaxwell.com if you are interested in grabbing a copy of the book. We're going to go to an email now. We have Tim who's emailed us, and Tim says, given the new norm within global financial markets, does the traditional buy and hold strategy still make sense for self-managed super funds, or are more dynamic asset allocation strategies a better solution to protect capital in down periods and enhance capital in good times? What a great question, and this is certainly the question of the times. We've seen the markets in Australia fall 1.6% today. In August, we saw 3 of the largest falls in history in the top 20 Dow Jones movements. So very, very volatile times. Alex Cook, please answer this question for us.
Sure, Sam. Yeah, look, my personal view on this is that buy and hold is dead. Traditionally, and certainly over the last 30, 40 years, it's made sense to hold shares and hold them for significant periods of time. And certainly over the last 30, 40 years, if you'd held shares from 1980 through to today, you'd be up a couple of 1,000%, so you would have done extraordinarily well. We're now entering a period in human history where there's 2 key long-term issues that I see, and that is debt and demographics. We're facing an ageing population with the baby boomers all hitting retirement, and that is going to cause economic weakness. I don't see any way around that. And the second issue, of course, is the debt, and you're seeing the debt issues in Europe, but they also exist to a large extent in Japan and the US. So I think you do need to take a far more active approach in protecting your capital, and certainly over the last 6 to 12 months with our clients, we have been dramatically increasing their cash exposures, into many cases as high as 70 or 80%, for this very reason, that the share market quite regularly throughout history, and if you look at every sort of 30 or 80 years, the share markets have significant bear markets where they last for long periods of time, like 5 to 10, if not longer, periods of time. So you do need to take a far more active approach in your asset allocation, in my view.
I can see Louise Biddy nodding her head on that one. Louise, what are your thoughts on asset allocation?
I think it's particularly important. I'd agree, but I think it's also particularly important in the pension phase, because particularly if you're just starting up a new pension in your self-managed super fund, the first few years are so critical to how long your money is going to last, and you need to protect the performance and the value of what you've got in there and where you're actually drawing it from. So when you're in the pension phase, I think it's actively managing how you're choosing your asset allocation, where you're drawing your pension payments from within that asset allocation. And it's also looking at the amount of money you've got, the expected time frame that you're going to live, and do you need to just maintain capital to get you through that period of retirement, or are you looking at getting better growth to boost your lifestyle as well? And that can make a big difference. So I think here a lot of it, and one of the previous questions was talking about, do you just make all these decisions yourself, or do you consult a financial planner? I think in a lot of cases where the value of the planner adds is within those strategies, how you manage the money, not just what you choose and which investments you select, but the whole strategy of how you choose drawdowns, when you make decisions about buying and selling, the taxation strategies, the estate planning, and all those other things which can have an impact on your returns as well.
Great answer. One of the things that always fascinates me is when markets go down, people want to sell, and they're often selling when markets are at their cheapest levels. Certainly I was out there buying today, and we did actually top up on a few shares across the client portfolios. But when I talk about shares, for my clients, my average client's about 62 years of age, and the average they invest with me is somewhere between $800,000 and $1 million. So they're generally retired or close to it, and they're also fairly conservative. So therefore they want to maintain their capital as best as possible and also produce an income over the long term. So for most of my clients, at least 55% plus have around about 50% in cash and fixed interest. So we're still holding very, very high levels of cash and fixed interest, but we're certainly trading where we can. We're not deliberately trading shares on a daily basis or anything like that, because that triggers higher brokerage costs, but we're certainly looking to take advantage of situations where shares look cheap and we can get good companies at good prices. So thanks very much to Tim for that email. We've got Patrick now online. Patrick, you have a question for the panel? Go ahead.
Hi, just a quick question about self-managed super funds and namely purchasing a property in the self-managed super fund.
Sure.
My question is, what are the restrictions in terms of renting the property out, and who you can, who you can't? What type of restrictions are there for that?
Yeah, good question, Patrick. And I've certainly seen a lot of problems around this when it comes to self-managed super funds. It is one of those serious problems that people need to understand how they can access their funds and what happens when they have, say, an in-house asset. I'm going to go to Louise Biddy now. Maybe you can tell us about in-house assets and the rental of properties.
Yeah. With properties, you need to make sure when you're renting them that you're renting them purely commercial terms, so what you would do at a third-party arrangement, and also to somebody who is at arm's length to you. So you can't rent it to yourself, you can't rent it to your relatives, to other members of the fund, to people that are what they call related parties, without causing it to be an in-house asset. And if you have an asset that's an in-house asset, it needs to be less than 5% of the total value of your fund. So unless you have, we talked about that a little bit earlier, if you have a very big fund and this asset is less than 5% of the total money you have in there, then you can rent it to anyone you like, but it still needs to be commercial rates. But for most of us, it means you need to go out and just rent it to somebody, a completely third party that you don't know, unrelated to you, and at commercial rates.
Louise, we might just talk about the rules of self-managed super, because I don't think a lot of people actually understand the rules of self-managed super funds and the fact that they operate under a very strong mandate that self-managed super fund is for the primary purpose of providing benefits for retirement. How well do you think trustees understand their mandate from the ATO in that regard?
I think a lot of trustees don't know them so well. They don't realise that there are a lot of rules. They think it's their money. They think it's a bank account that they can set up and run that however they like, doing the best that they can to get a good return from it. But as you say, there are so many other rules. The rules for superannuation don't restrict what you can buy, but what they do restrict is who you can buy it from, what you can do with it once you've bought it, and when you can actually sell it as well. So there are rules around how you buy it and how you use that asset and why you've bought it, so the intention behind it as well. And it's really important to get that right, because as we mentioned at the early part of the show, if you get it wrong, there's jail sentences, fines up to $220,000, and lose half your fund to the tax department potentially. They're the extremes of what can happen and what can go wrong. But a lot of trustees go into it without understanding fully. So a lot of research, a lot of time spent understanding the rules, getting good advice, using a system that can help you manage the administration. There are some checks and balances when you do your tax return and having to get your fund audited, but sometimes at that point you've already made the mistakes, and so it's better to have an awareness and not make the mistakes at all.
Sally Patton, editor at Financial Review, you're nodding your head enthusiastically. What are your thoughts there on trustees' knowledge?
Well, yes, it's interesting because nearly 60% of trustees say the reason they set up a fund is because they want control. Yet I write this series for the paper and for our website called My DIY, where I go and interview lots of professionals in the financial services sector about their own DIY funds, their own self-managed funds. And when it comes to ask them about their returns, about half, I would say, about half the people know what their returns are. When it comes to ask them about their expense ratios, I would say about 10 or 20% of professionals in the industry know what their expense ratios are. So that means that not very many people know what their net returns are, which means they can't really go and compare them with what they could be getting, say, in the industry, in an industry fund or a retail fund. And I think that's really a bit of a concern. I think that self-managed funds trustees really should know exactly how much what their returns are, and know that they are in the right place and they are running their fund for the right reason.
Absolutely. I think that's one of the biggest issues. And can I just say, if anyone's out there thinking about setting up a self-managed super fund, or even if you've got a self-managed super fund, there's some great resources on the ATO website. In fact, there's a whole booklet you can download called Running a Self-Managed Super Fund, another one called Setting Up. Are you interested in setting up a self-managed super fund? I definitely recommend that you download these booklets and read them cover to cover. They're fairly easy to read, but they're a fantastic guide on what you can and can't do inside a self-managed super fund. We have another question from Peter in Brisbane. Peter, go ahead.
Hi guys, how you doing?
Well, thanks, Peter.
Yeah,
what's your question tonight?
My question is, self-managed super fund that I start up for myself, what would be the round ballpark you need to start, to get off the ground?
As in your funds inside your super fund?
Yeah, that's correct.
Listen, the ATO sets a benchmark around about 200,000, but that being said, it's not actually a legislated benchmark, it's really just a guide, and as Sally Patton just said, it's really based around looking at what your expense ratios are going to be and understand how much the fund's going to actually cost you. To set up a fund, you're probably looking at somewhere between $500 and maybe $1,000 through an accountant or a financial advisor like myself, or a specialist administrator, and then you're probably looking at around about $2,000 to $3,000 a year to administer that fund. So you've got to keep that in mind. But if you have less than that, for example, you might have $100,000 in your fund, but if you're putting in, your $50,000, or you've got a couple putting in $100,000 a year into that super fund, then you can probably justify having a lesser amount in the fund. Alex Cook, what are your thoughts on the threshold for self-managed super funds?
Yeah, well, as you say, there's no legal minimum, but I think really it depends on two factors. One is that depending on your phase that you're at. So if, for example, you're just about to retire, it wouldn't make sense to set one up with, say, $200,000 in it if you're going to be drawing down on it. Really, if you're going to be drawing down on a pension, my view is you need probably closer to $500,000 to make that worthwhile when you allow for the fact that you're going to, as Sam was saying, pay accounting fees of somewhere in the vicinity of $2,500. On the other hand, if you're, say, 35 years of age and you're starting out and you're saving quite a bit of money each year, and you're going to put, you're going to salary sacrifice into the fund, the actual account balance won't matter as much. It'll still matter because you're still going to be paying fees that are going to be eating into your annual return, but nonetheless it won't matter as much as someone who's already in that drawdown phase.
Thanks, Alex. That's a good answer. And thanks very much to Peter from Brisbane for the question. We have another Brisbaneite on the line. Ian, you have a question for the panel. Go ahead.
Yeah, thanks very much. Look, I have a property which is rented outside of my superannuation fund. I'd like to know what's involved in moving that property into the superannuation fund.
I love this question, Peter. Thank you very much for asking it. The fact is you can't actually move a residential property or transfer a residential property from outside super to inside super. You can, in fact, purchase a new asset inside your super fund, but there's no way that you can transfer a residential property from your own individual name, joint names, etc., outside of super inside the super fund. Not exactly sure what the reasons why, but I would imagine that people could play around with the valuations on that, which could affect stamp duty and obviously the contributions to superannuation. The fact is, though, you can move commercial property, you can transfer commercial property from your own name to a self-managed super fund, but I might go to Louise Biddy and just get her comments on transferring properties into self-managed funds.
I think you answered it well. I mean, it's really cut and dried with the residential ones that you just can't do it. And you're right, it is about the fact that you can't get a true valuation. The only way you can really value a property is to get somebody who's got no self-interest in it to actually buy it off you. And so the tax department won't allow that. The commercial properties you can. So your choices are that if you want to have property in there, do you then sell the one you've got and go and buy a new one? Or do you just start a new one with other money that you have?
Sure, great. Thank you very much for that call, Ian from Brisbane. We have an email now from Alison. Alison emailed me and asked, I'm 50, thinking of retiring early and have found $350,000 in a Telstra Super and have just started working for a charitable fund part-time. I don't get paid a great deal, however the job is very satisfying. Is there anything I can do to access my super to support my wage that would allow me to continue working for this charity? Alex Cook, what are your thoughts on this one?
Well, unfortunately, you haven't reached preservation age yet. So you'll only be able to access it once you hit 55. That's preservation age. And so until that point, unfortunately, you won't be able to access your super, I'm afraid.
Yeah, great answer. Preservation age is obviously a really important one there. Preservation age being 55 or over 55 and retired. Louise, what are your thoughts on this one?
Yeah, the only things you might be able to do is once you do get to 55, if you're still working, then you can't take it out. But what you can do at 55 is start a transition to retirement pension. And what that would do is allow you to take 10% or up to 10% of the balance of your fund each year as extra income, and that would help to support the income that you're getting now. Working for a charitable organisation, one of the things you might do to help boost your income, though, is to have a look at the salary sacrificing packages that they may offer, because charitable organisations do have a lot of concessions with your salary and your options about a salary package, and that can sometimes help to boost what is otherwise a lower wage as well. Yeah,
great answer. I think just to elaborate on that point about access to superannuation, I was actually doing a story on another network the other day about the early access to superannuation, and there's been a few scams around where people have helped other people get access to their superannuation early. So it's very, very important to understand that the ATO is really cracking down on this, and to understand that you can't actually get access to your superannuation funds until you reach a condition of release. We have a final caller here, Philip from the South Coast. Philip, what's your question tonight for the panel?
Mainly wanted to ask about diversification. Wife and I are self-funded retirees, around about 64 years of age. We have about 300k in term deposits within our super fund and about 270k in shares. but I also have about 700 Ks of investment property outside of super, and which we receive around about 30K a year for rent. Our shares on forward dividends I've worked out, including franking credits, give me around about $21,000 to $22,000 a year of income, plus our term deposits. Do you think that this is, am I well enough diversified to get me through the crisis, and with income, and I'm only taking enough income that I don't draw down my capital? So
Philip, it's certainly a great question, and it's certainly one of the sign of the times at the moment in the current environment, where we're seeing certainly great moves in share prices, and we've also seen quite a lot of decreasing movements in house prices over the last few weeks, months, and even years in certain areas, particularly around your area on the south coast. So by the sounds of things, the way you're diversified actually sounds pretty good to me. So I would suggest that you're probably in a fairly strong position in terms of diversification. But at the end of the day, it's really up to the individual. And I suppose as a financial advisor myself at Henderson Maxwell, we spend a lot of time talking to clients about their diversity and their exposure to certain risk assets and what might happen if markets do go south. But thank you very much, Philip, for that question. Great question, and certainly one for the times today. That's all we have time for tonight on Your Money, Your Call. So thank you so much for joining us. It's been a fantastic night. Unfortunately, not a fantastic day on share markets, but thanks very much for joining us. Thank you very much to Sally, Alex and Louise on the panel, and thanks very much for your calls and emails. That's all we have time for. Thanks for joining us. Good night.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.
Good evening and a very warm welcome. Tonight we have a very special edition of Your Money, Your Call. We are talking self-managed super funds. My name's Sam Henderson, CEO of Henderson Maxwell, an independently owned financial planning firm that specialises in the setup, administration and funds management for self-managed super funds. And I'll be your host tonight while Chris Gray is away. We have a huge show for you tonight, and joining me here are three of the best experts in the self-managed super fund industry. Sally Patton, editor for DIY Super at the Australian Financial Review. Welcome to the panel, Sally. Joining her is Louise Biddy, Director at Strategy Steps, a firm specialising in technical services for the financial planning industry. Welcome, Louise. And last but not least, Alex Cook, Managing Director of Arcadian Private Wealth Management. Welcome, Alex. If you have a question for our panellists regarding the setup of a self-managed super fund, running a self-managed super fund, contributions to super or pension rollovers, portfolio management questions relating to self-managed super funds, we want to hear from you. Don't be shy. This is what you need to do, is pick up the phone and dial 1300 30 34 35 right now, or email us at yourmoney@skybusiness.com.au right now. And I'd be delighted to have our panel address any of your queries tonight. The first 5 callers or emailers will receive a free copy of my book, Financial Planning DIY Guide, which is currently available at Dymocks and all good bookstores. You'll also get a reserve copy of my new book, Self-Managed Super Funds DIY Guide, due out in Christmas.
Welcome back to the show. Now, the retail sector, as we've been already saying, undergoing sweeping structural changes. It's threatening, really, to ruin traders who fail to adapt. Certainly, that was a stern warning delivered this week by Premier Retail Chief and former DJ's head, Mark McInnes. He says that retailers who believe the sector is simply at a cyclical nadir are fundamentally wrong. Indeed, he says none of the big department stores are facing up to the international threat of online shopping. Well, what next for this retail revolution? I'm joined now by publisher and editor of Power Retail, Grant Arnott, in our Melbourne studio. Grant, welcome into the show. There is an irony, if ever one was looking for one, that Mr. McInnes, who was very much, you could say, in the Jerry Harvey school of internet deniers for so long, belatedly joining the party. Tell me what it is, as it is playing out now. You're fresh back from Boston and you've seen it close up at a Congress there.
Look, I think Mark McInnes was perhaps looking at DJ's earlier venture into online retail, which was a demonstrable failure, but it was the wrong time, and now is absolutely the right time for online retail. We're seeing that proven time and time again in what we're seeing, also where we saw what I saw last week at the shop.org summit in Boston, is that online retail is the boom component of retailing, and not only is it booming in its own right, but it's also driving more traffic in stores for those who play their cards right. I mean, Next week at the Online Retailer Conference in Sydney, we're going to be hearing from John Kamaludin, the International Director of ASOS, and he's going to be telling delegates that on a busy day they fill half a 747 with products bound for Australia. So that's how big the demand for online shopping is in Australia, but unfortunately the local retailers are yet to get the game fully together and offer it. And as a consequence...
Yeah. When is it game over, though, given that so much of that model is playing off an Australian dollar, which has been pretty healthy and pretty kind to us who look offshore for bargains aplenty, but now with the worm turning and a push back towards, some have said overnight, 85 US cents, is it still game on?
It's very much game on. Online shopping is not only about price. I think that's what